The development of money is a fascinating story that spans thousands of years and involves many cultures and civilizations. Money is any item or record that is widely accepted as payment for goods and services or repayment of debts. Money can take various forms, such as coins, banknotes, checks, credit cards, digital currencies, and more. The following is a brief overview of how money evolved over time. The earliest forms of money were commodities that had intrinsic value or usefulness, such as cattle, grains, shells, beads, metals, and spices. These commodities were used as mediums of exchange in bartering systems, where people traded goods and services directly without using a common unit of account or standard of value. However, bartering had some limitations, such as the need for a double coincidence of wants. Both parties had to want what the other had to offer, the lack of a common measure of value, how much of one good was worth another, and the difficulty of storing and transporting bulky or perishable goods. Around 1300 BC, the ancient Mesopotamians developed the first system of writing, which enabled them to keep records of transactions and debts. They also used clay tablets as tokens to represent units of value, such as bushels of grain or jars of oil. These tokens were the precursors of money as a record or a claim on a commodity. Around the same time, the ancient Egyptians used gold rings as a form of money. Gold had several advantages as a medium of exchange. It was scarce, durable, divisible, portable, and universally desired. Around 1200 BC, the Chinese invented the first metal coins by casting bronze into standardized shapes and sizes with inscriptions or symbols. Coins were easier to carry and store than commodities or tokens, and they also had a fixed value that was guaranteed by the authority that issued them. Coins soon spread to other regions, such as India, Persia, Greece, Rome, and beyond. Coins became the dominant form of money for centuries, until paper money emerged in China around the 7th century AD. Paper money was initially a form of promissory note, or receipt that represented a claim on a certain amount of coins or commodities stored in a vault or treasury. Paper money was more convenient and flexible than coins, as it could be issued in larger denominations and circulated more widely. However, paper money also had some drawbacks, such as the risk of counterfeiting, inflation, when too much money was issued relative to the available goods and services, and depreciation, when the value of the underlying coins or commodities declined. In the 17th century, Europe witnessed the rise of banking and credit systems that revolutionized money and finance. Banks were institutions that accepted deposits of money from customers and lent them out to borrowers at interest. Banks also issued banknotes that were backed by their reserves of gold or silver coins. Banknotes were more convenient than coins because they could be transferred by endorsement, signing over to another person, or by writing a check, a written order to pay a specified amount to a named person. Banknotes also facilitated international trade by allowing merchants to exchange different currencies at fixed rates. In the 20th century, money became increasingly digitalized and abstracted from physical forms. The invention of electronic payment systems such as credit cards, debit cards, wire transfers, online banking, mobile payments, and cryptocurrencies enabled people to make transactions without using cash or checks. Digital money also allowed for faster and cheaper transactions across borders and continents. However, digital money also posed new challenges and risks, such as cyber attacks, frauds, identity thefts, privacy breaches, and regulatory issues. The development of money is an ongoing process that reflects the changing needs and preferences of human societies. Money is not only a medium of exchange, but also a store of value, a unit of account, a standard of deferred payment, and a symbol of status and power. Money is also a social construct that depends on trust and confidence among its users. Money is not neutral, but affects economic activity, social relations, political institutions, cultural values, and individual behaviors. Money is not only an economic phenomenon, but also a historical one that tells us about the past and shapes the future. Don't forget to like and subscribe to this channel for more finance videos.